Today, I'm Abha Bakaya. Here are the day's top stories. Reserve Bank of India all set to raise interest rates tomorrow for the fifth time this year, may slow the pace of hikes after inflation falls below 7% in October. Watch the results of BTTV poll in the show. Wary day on the Indian bourses as Street awaits the all-important announcements from the RBI tomorrow. Rangebound with IT, pharma and metals leading the losses. PSU banks remain in the green. The Nifty closed down nearly 60 points. Sensex was down almost 200 points. Market guru Andrew Holland lauds a rotational play on the bourses, says Tyres, paints and oil marketing companies will keep things buoyant. With slowing rate hikes, Holland expects money to return to emerging markets in the new year. Rupee plunges 82 paise in trade today, closes at 82.62 to the US dollar, its lowest close in more than a month, follows a broad decline in Asian currencies. Could Budget 2023 announce a big tax break for the middle class? Banks reportedly seek tax exemption on interest from fixed deposits of up to 5 lakh rupees, want a level playing field with mutual funds and insurance schemes. Huge boost for Make in India. Apple is said to be shifting a chunk of production of its iPhones and other products to India from China, looking to hedge its bets after the recent unrest at its biggest plant. The stage is set for a fifth consecutive rate hike this year, with the RBI governor announcing the decision of the central bank's Monetary Policy Committee tomorrow morning. Repo rates have been raised by 190 basis points since May this year, with the RBI putting inflation control on top of its agenda. The central bank had set 6% as the upper limit for inflation, a limit which has been exceeded every month since January. The only bright spot is that inflation has fallen in October, raising hopes that the RBI may slow the pace of its rate hikes. In fact, an online poll conducted by Business Today TV showed nearly 3/5 of respondents predicting a 25 basis point rise in tomorrow's announcement. 22% of those polled see a 35 basis point rise, while the rest expect interest rates to rise by half a percentage point. So what will the RBI do tomorrow? Business Today managing editor Siddharth Zarabi spoke to Siddharth Sanyal of Bandhan Bank. Here's an excerpt.
Question that I am now posing to you before we move to the growth impact: what has the RBI's 190 basis points hike achieved so far as controlling inflation in India is concerned?
Global supply bottlenecks, Ukraine-Russia war, as well as I'm saying, the weather-related disruptions are not under the influence of RBI or repo rate or any monetary policy action. Having said that, I think it was very important for RBI to take into account that some kind of an overall messaging, some kind of a messaging so far as some of the segments like retail lending, etc., is concerned, where they're pushing banks to be slightly more conservative. They are trying to ensure that expectation around the exchange rate remains somewhat anchored. They convey the message that the central bank is a true inflation fighter central bank, and all these things were done started from a point where the repo rate was significantly lower than its usual habitat. Now, I think we have made significant progress on these aspects, and which should provide some bit of relief to the RBI.
So that's an important point that you make. And before we come to your own expectations and what are the other forecasts, it's very clear at this stage that various other analysts as well have given their own expectations. For example, if you see, Nomura says 35 basis points, ICICI says 35, Barclays 35, Kotak 35, and of course this is stuff that we already have. Siddharth, what's your own number that you would like to add to the mix?
I know there is an overwhelming majority is there at 35 this time. I'm slightly more conservative in terms of an RBI hike. I think I'd prefer a 25. I think the 25 basis point kind of a hike is the usual cliff size. We had moved to a relatively unusual cliff size of 50 basis point at some point of time. The discussion about 35 is rather some kind of a messaging somewhere in between, and also to arrive at some kind of a quote unquote round figure in terms of the repo rate. I think rather than getting into that zone at this moment, a more usual 25 basis point is more likely and more logical in my view.
If inflation, the peak is behind us, what happens to this number on the screen, which is growth? Because growth is ultimately very, very important for a massive and growing population country like India. Siddharth, would you agree?
Absolutely. And my sense is that the growth bit is a slightly more complicated scenario rather than inflation at this moment. Because on one hand, as you were rightly saying, that the immediate pressure on inflation seems to be coming better under control, but the rates which has got elevated at this moment will stay there for a while. We are in this particular hiking cycle, we are for the first time in our history that we have a very significant EBLR book, that is the external benchmark linked lending book. That at some point of time in the previous hiking cycle, we are possibly having just about 5% of our rates linked to the EBLR. Today, close to 50% of our rates of the banking sector is actually linked to EBLR. That means whatever hike RBI delivers, it gets transmitted almost fully and almost instantaneously for that particular part of the book, 50% of the book. So that makes the rate transmission much more. You can make it, you can call it effective, but at the same time, it's very powerful at the moment.
Well, it was red across the screen today on the Lal Street. Benchmarks ended lower ahead of the all-important RBI announcement on repo rates. The Nifty closed above the 18,600 mark. Sensex also declined a little over 200 points at close. IT, metals, pharma stocks among the top laggards, while the PSU Bank Index was up 1%. BPCL, Hindalco, Tata Steel, Dr. Reddy's and UPL were among some of the top losers of the day. While Adani Enterprises, Hindustan Unilever and Nestle maintained their stance in the green. Speaking with us, Andrew Holland, our market guru, told both Udayan Mukherjee, our global business editor, and myself that he does expect money to return to emerging markets as the Fed lowers the pace of rate hikes, sounding optimistic on India's consumption story. Here's a slice from that conversation.
It's been a great year for India overall, and I think, Udayan, it's probably been easier to kind of call the global markets than it has the Indian market. It's been so resilient. Perhaps that because we have more deeper sectors than some of the other emerging markets, and more variety of sectors. But valuations remain lofty, and earnings have yet to kind of really pick up. I mean, again, at the beginning of the year, we were talking of 20% plus earnings growth, and it's looking as though we're going to get just about double-digit earnings growth for this year. So, unless earnings really start to kind of pick up momentum going into next year, it's going to be hard for the PE expansion just to keep continuing at this pace. Sectors like paints and tyres and the kind of oil marketing companies come back into play after being out of favour for so long. So those are the kind of rotation in the market which could keep things buoyant a little bit longer.
The fear, though, Andrew, is that while we may end the year well, as we start the new year again, some of the recession worries and the earnings slowdown worries come back, and 2023 starts not on a very cheerful note. It's happened in the past where you end the year well and the next year does not follow up in quite the same spirit. Is there a risk of that this time around too?
There's always that risk. I remember, again, I was probably speaking back in 2007 when India was decoupling from global markets, only to find out what happened in 2008. So there's still that risk that unintended consequences of interest rate hikes globally could lead to some problems in the financial markets. We've seen it in the cryptos. We saw it with in terms of the UK pension funds. So there's something out there which we still have to watch out for, and it will be financial. It won't just be economic.
So Andrew, what would continue to be your top picks, or would you be kind of holding back for the moment, seeing how things stabilize?
No, Abel, we have been putting more money to work. We still believe that inflation is probably peaked in the short term. The question is whether it will linger for longer, and that kind of stagflation kind of scenario starts to come through. But we're very much in the camp that inflation will start to tick down now globally, and therefore that deflation play, which is obviously banks and consumer, mainly autos, would still play out very well over the medium term. So that's where we're putting our money at the moment. But the themes that we're looking at, going into 2023 would be more towards, the capex cycle picking up globally and in India, particularly in those sectors where supplies or security of supply has been an issue, not just globally but for India too. So areas like semiconductors, we think electronics will be another big area for investment.
There's a lot of excitement around manufacturing as a theme, Andrew, in the market. Within that, one of the sectors where people generally scouted for mid-cap opportunities would be the auto ancillaries or auto component space, because there are quite a number of decently managed companies in that space. Do you have any strong views on either ancillaries or the automobile space per se as we go into 2023?
No, we like the autos. We think, the consumption story in India is not going away. It's a long-term theme anyway. I would probably go for the passenger cars rather than two-wheelers at the moment, although we are seeing a pickup in demand for two-wheelers and tractors as well. But I think that might be just a more seasonal part to the buying patterns that we normally kind of occur in India. So the way I want to play it is really whilst electric vehicles I think will be very, very important, I think it's the auto parts makers I think will benefit, because it's hard to pick out who would be the real winner in electric vehicles at the moment, because everyone's investing and there's a lot of change ahead. But the auto parts companies will be the ones that be the beneficiaries of this.
Let's take a very quick break. When we return, will fixed deposits give you tax-free returns? More on that.
This is the government secondary school in Betul's Kelapur village. And this is a new method of teaching designed by social worker Rajesh Sariyam. The children are learning multiplication tables presented in the form of a tribal folk song. Teachers say the song and the dance routine make studies more interesting for kids.
मैंने सोचा क्यों ना बच्चे लोगों के लिए हम लोग एक आदिवासी धुन के ऊपर पहाड़ बनाएं, ताकि बच्चे बगैर मानसिक तनाव के झूमकर नाचकर पहाड़ याद कर सकें, और साथ ही साथ सभी शिक्षकों का इसके अंदर बहुत अच्छा सहयोग मिल रहा है।
इसमें हमको सरियाम जी का एक और अच्छा वो मिला, उससे हमने बच्चों को बहुत अच्छे पहाड़े सिखाने की योजना बनाई, और इस योजना के आधार पर बच्चों ने बहुत अच्छे 10 तक पहाड़े बनाए।
Students also appreciate the novel teaching method.
पहले हम पहाड़े भूल जाते थे, अभी मोबाइल के अनुसार डांस कर कर पहाड़े याद कर लेते हैं।
याद हो जा रहा है?
यस सर।
Learning is fun is a catch line often used by schools. And at the Kelapur Government School, learning is quite literally fun. Bureau Report, India Today.
Welcome back. A tax proposal forwarded to the Finance Ministry, if included in next year's budget, could mean a big break for the middle class. The Indian Bank Association is said to have petitioned the Finance Ministry to exempt income tax on interest earned from fixed deposits of up to 5 lakh rupees. Indian banks have been witnessing a much slower growth in deposits than in credit, with a lot of people preferring investments in mutual funds and high-return insurance schemes. Currently, FD interest is taxed on the basis of the taxpayer's income slab. There is no exemption available on fixed deposit interest. The only exemption is for interest from savings under Section 80 TTA. That's for individuals, and 80 TTB for senior citizens. For more on this, we're joined by Business Today's personal finance editor, Tina Jain Kaushal. Tina, why have banks asked to make investments in FDs tax-free?
Hi Abba. The Indian Bank Association has asked the Finance Ministry to make investment in FD up to rupees 5 lakh tax-free. And one of the reasons for this demand in this budget is the widening credit and deposit gap. To give you a statistic, credit is growing at the rate of 18%, while deposit grew just by 8% in the month of November. So there is a gap of 9% in credit and deposit. So banks have to fill this shortage in deposit. They can do it either by making the deposit rate attractive, or they can give it by having more tax benefit on FDs. So clearly banks are under pressure to increase their deposit base, and that's why there is this demand of tax benefit on FDs.
So what are the existing tax benefits, Tina, when it comes to FDs?
So if we talk about the existing tax benefit, there is one available under Section 80C, under which if you make an FD of 5 years, there is a lock-in of 5 years, then you get a deduction under Section 80C, which is up to 1.5 lakh. But again, that interest, this interest income is also tax-free if you make this a 5-year FD. To compare it with the debt funds, which are the closest competitors, there's a tax advantage that debt funds have, because they are taxed at 20% with indexation, while FDs are taxed at the tax rate which you fall into. So clearly debt funds are having a tax advantage over FDs, and that's why there is this call is coming to make FDs at par with debt funds, or have at least lower rate compared to debt funds.
All right, Tina, thanks so much for joining us with that. India all set to take a bigger bite of the apple. According to reports, the Cupertino-based tech giant is looking at hedging its bets by increasing iPhone production in India. The recent labor unrest in China has resulted in huge waiting lists for top-end iPhones and seems to have convinced Apple to not place all of its eggs in one basket.
These were the scenes outside the Foxconn plant last week. The world's biggest manufacturing facility of iPhone and other Apple products in Zhangzhou, China, was the site of unprecedented pitched battles between workers and police. The plant, with more than 300,000 workers, manufactures 85% of the iPhone Pro lineup. The riots, which were a result of China's zero-COVID policy and also of living conditions inside the plant, reportedly reduced the production by 30% in the plant. For Apple, the timing could not have been worse. The production cut coincided with peak festive demand in Western Hemisphere. For the first time, Apple is grappling with waiting periods for its top-selling models at Christmas time. And now, China's loss could be India's gain. According to reports, Apple is considering shifting a chunk of production from China to other countries like India, US, Malaysia and Vietnam. And India, which already has 3 manufacturers, Foxconn, Wistron and Pegatron, producing Apple products, is said to be a big gainer. A report, in fact, claims that the share of India in Apple's total production could rise to 20% from the current 5% in the next 3 to 4 years. China's share in iPhone production is in fact dipping the past few years. It is expected to fall to between 91 and 93.5% this year, from around 96% in 2021 and 98% in 2020. India has already been rising in prominence for Apple. the company had for the first time started the production of iPhone 14 within just 10 days of its global launch. There are reports that the top-end iPhone 14 Pro model will also be soon manufactured in India.
While there is a lot of enthusiasm, there are some red flags as well. Even the most optimists believe that production is going to rise at a slower pace. Some of the issues are labor issues. The labor in India is not as skilled and trained as it is in China. Moreover, the infrastructure to support higher production is also not available in India. Well, what's working in India's favor is the government's PLI schemes as well as its initiative to make in India. This was Akanksha Chaturvedi for Business Today TV.
The big fat Indian wedding is back. Forced on a strict diet by the COVID pandemic and the resulting lockdowns, the Grand Band Baja Barat festival is roaring back again. And that's fantastic news for millions dependent on an industry intricately woven into this mega celebration.
Weddings were locked down by COVID. But this year, the enthusiasm has finally broken through all restrictions, along with the Band Baja Barat. The big bucks are back for the wedding industry. The ongoing wedding season is turning into a gold mine for traders and allied businesses after a 2-year of hiatus. An estimated 32 lakh weddings are expected to be solemnized in the 1-month season, which began mid-November. More than 10% of these are in the Delhi NCR area. According to the Confederation of All India Traders, the spending this year will exceed 3.75 lakh crore, 25% up to the last year's numbers. Businesses not only expect cash flow to reach the pre-pandemic levels, but to exceed it by a large margin. Those looking at the big numbers include jewelry, home improvement, catering and food, printing, flower, event management, and the banquet and the hotel businesses.
Even if I assume that 2%, just 2% of the 32 lakh weddings come to hotels, that's 64,000 weddings coming to hotels in the next 4 months. Let me do a simple math for you. If each wedding only gives 50 rooms for just 2 nights, you know what that number comes to? It's 64 lakh room nights, which if I divide over the next 4 months is more than 50,000 rooms daily. So that gives you a little synopsis of what the demand for the next 4 months from this one segment alone is looking like. And let me tell you, it's never been like this before.
This is despite high inflation and the rising interest rates, which are making borrowing expensive for the common man. There has been some impact of the pandemic though. Guest lists today are slimmering and off-season weddings have increased. However, the expenditure has not seen a drop. Looks like the stars are aligned for the industry once again. Bureau Report, Business Today Television.
My colleague Sakshi Batra had the chance to speak to a panel of guests closely related to the wedding industry about the economies of the wedding season. Here's an excerpt.
How has this season kick-started for the traders and for the business community? And is the industry really looking to get back on track after the setback that we actually saw in the pandemic? Are we actually going to do much better than the pre-pandemic levels?
We carried a survey in 35 cities of the country, including Tier 2 and Tier 3 cities. And most of the people, those who avoided marriages in 2020, 2021 for one reason or the other, now they are in enthusiastic mood. And that is why this whopping figure of 32 lakh marriages in just 13 days.
Yeah.
And with an expenditure of 3.75 lakh crores of rupees, and the kind of rush what we are witnessing in Delhi and my fellow colleagues are witnessing in other parts of the country, it will not be strange if we cross 4 lakh crores of rupees by 14th of December, when for 1 month there will be a rest for wedding season. And again from 14th January to 15th of July, there is going to be a massive wedding season.
Okay.
And now we can safely say that that earlier it was considered that Diwali season is the biggest season for the traders and for the public. But now wedding season is equally going to be as good as Diwali season.
Let me take it across to Vikas. Help me understand how is the demand shaping up for you, and as a sector as well, as a whole, what is the kind of expectation in terms of where is the maximum demand really coming in as far as both gifting and flower decoration requirements are concerned?
I think the weddings are not only back; they're back with a bang. We definitely see a increase in demand, and going further, there has been there's a very good season ahead in terms of November, December. But as per my bookings and knowing the industry very closely, January, February looks more exciting because there are more number of dates, and people are getting a lot of time to prepare because November, December dates were few. And all the dates were blocked much in advance. So everybody had to kind of push it to January, February. So next 4 months, November, December, January, February, I think will make us recover a lot, which we lost in a couple of years. We are definitely seeing a growth. I mean, we'll be doing 50% more than the 18-19 period, definitely.
Mr. Khandelwal, I want your understanding also on this. Firstly, the impact of inflation, the rate hikes as well during this year. Has it had any impact on the budget spends or the expenditures planned for the wedding this season? And where are people really spending most on in this season particularly? Is it the same old trend that you've witnessed, or is it a change right there? Like you pointed out, the guest list has shortened, so perhaps the per place cost has really gone down for the people. But where has it really gone up? Where are people spending more?
Sakshi, more or less, the inflation has not made any impact on the spirit and enthusiasm of the wedding. Of course, since 2019 to 2022, there is already an increase of 15% to 20% in each and every commodity. But even then, the kind of weddings, the kind of expenditure, what we are witnessing, it has not dampened the spirit of the people. Around 40% weddings are of big fat weddings, and 60% are of ordinary weddings up to 25 lakhs of rupees.
And that's where we leave it on the show tonight. Thanks for watching.